Hey there, traders and friends, market participants and enthusiasts right around the world. Thanks a lot for joining me on this Tuesday afternoon market recap. It has been a tremendously volatile week of trade so far. That is Monday through Tuesday. Yesterday, of course, the market staged a relatively healthy push to the upside. However, that has fizzled and we did just see a major intra-session reversal take place in the last 1 to 2 hours of trade on Tuesday. Collectively, we saw the Dow Jones Industrial Average lose 344 points. It was an absolute bloodbath. We almost gave back the majority of yesterday's session's worth of gains. Of course, there is a little intra-session gap between the close on Friday and the open on Monday, but for the actual open of trade, the trade in which yesterday and today has taken place, a lot of those gains have been given back. It looks even more ugly on the S&P 500. We definitively closed below the open of yesterday's candle. We closed down 45 points. And again, this is a continuation candlestick signaling that the momentum, at least to the downside, is still firmly in control of the sellers, or the sellers at least have control of this market for the time being. Now, again, if we step it up another level, the NASDAQ really takes the cake for selling during today's session. We closed down 211 points, a long day dark Morobozu. This is as ugly as what you can get. I know at least compared to some of the point losses in the past, it is not as significant. However, a lot of people, again, begin to panic or they become a little bit fearful after sessions that we have just witnessed as at the close of today. Now, the purpose of this video, once again, is just to remind you of the process upon which the market is moving through before we ultimately stabilize and again cooler heads prevail and ultimately see the market change from that of a relatively bearish picture that we find ourselves in at the moment, where again the sellers have control and that is nothing to be concerned about longer term, and eventually staging this market rally that we see moving back up to 26,435 to close this open window on the Dow Jones Industrial Average, and again, respectively, for the S&P 500 to see it push on back up towards 2,852. So it's very important that you listen to what I have to say as at the close on Tuesday so that you are not taken off guard by, again, some of this continued volatility which seems to persist and that just doesn't really want to go away. It's a little bit unclear as to how long this is going to linger for. But again, once you understand the larger backdrop, at least to the larger picture, that shouldn't be of concern. It's more so playing, of course, the ranges of support and resistance and ultimately playing the bounce from wherever the market actually stabilizes from. And again, that is what I'm going to talk about. So really, since we established or at least stabilized over here at the beginning of February, we've been calling for the secondary retest of this same pivot. This is also, of course, relevant to the S&P 500. The NASDAQ has been that outlier. The reason I say that is because the NASDAQ did come on back up here and post, of course, a new all-time high. So if I go back into the picture of the Dow Jones Industrial Average, you can see that we are starting, of course, to drill into the support area. Now, generally what happens is when you go through this this bottoming process, again, volatility generally spikes, and that's exactly what we're seeing for the first two sessions of this week. What you want to look for is after these long day dark candlesticks to see a consecutive series of white Morobozu candlesticks. We can also see, of course, hangman candlesticks, or at least hammer candlesticks that support anything which builds the picture moving forward that this support area is going to hold. Now, again, if I bring up these longer term simple moving averages, if I can push the right key on my keyboard and bring up the right template, we've been speaking about this rising 200 simple moving average as our target, or at least the closest, or at least the most definitive area, so to speak, of a legitimate target during this correction that we've been in since establishing the high back in late January. And again, it looked as though we were going to actually touch that moving into the week first thing Monday. That wasn't the case. We saw the markets again collectively gap to the upside and stage a rather healthy day. However, after today's session, it becomes even more clearer that 23,385 on the industrial average is going to be tagged. I'd be somewhat surprised if the industrial average doesn't hit the rising 200 simple moving average before the week's end of trade. Now, again, once we get down to this area, this is where you want to look for those reversal candlesticks. I would not be looking to play the downward momentum, although very clearly the bears do have control of this market. What you want to pay attention to is for our oscillators, as you can see on my screen, to push into short-term oversold territory. Now, we've already established that on the RSI. We did that as at the close on Friday, and it's already starting to recalibrate, but that is not enough. Generally, you want to see the stochastics push on back down below this 20 area. This registers that of, relatively speaking, oversold conditions, and generally once the stochastics get into this area, and the RSI is also in this area, combined with candlesticks also at that rising 200 simple moving average, that should be enough to actually slow this market and completely reverse the sell-off, essentially exhaust the sell-off. And this is where we should see the bulls come on back in. You can already see that one lower wick over here. Again, this was the ultimate low of the sell-off, that waterfall sell-off leading into the month of February. It's no surprise that the market itself is slowing down at this general area. So again, you have to expect this type of choppy market environment. It can persist and it can linger really indefinitely. There is no definitive sort of exhaustion for these types of periods in the broader market indices. However, you must recognize above all else that the trend that we have been in on the minor level and also the intermediate level within that of the macro level has changed, and we're no longer in a trend at the moment. We are in a sideways consolidation, and this is most likely going to set up in the form of a larger channel. Okay, but above all else, think about the market magnet. We should close this gap. Generally on market indices we will, and what this is doing right now is providing you with some really nice risk and reward ratios once we start confirming with price moving more so legitimately and more sustainably above certain resistance areas. Pay attention to this downward declining resistance area on my chart. Once we start breaking above this, that's going to be the best piece of evidence that we will have, along with, of course, these oscillators turning back up, that is going to be the sustainable move. But for the time being anyway, we need more evidence around this area, or at least around the support area, until we can definitively expect that bullish net movement to take us on back up to those respective resistance areas. And this process is probably going to take at least 1 to 2 months. It may happen relatively, more quickly. That would be ideal. However, generally after these sideways consolidations, if not large selling types of waves, it does come more so as a grind as we move higher. If we do, however, overshoot this resistance area, we do have further support areas down here. At this particular time, it's too early to say. However, that is why we've addressed the rising 200 simple moving average for the Dow Jones Industrial Average. The same is true here. On the S&P 500, you can see again, we more so tagged it on Friday last week. We saw that first bounce yesterday. However, today, it looks as though we are driving back into this rising 200 simple moving average. This is generally where corrections stop. They slow, then ultimately they reverse. So it's just a matter of time, and it really is just a waiting game, so to speak. Really just a period of sitting on your hands and waiting for the right signals before we can really trust and believe in this market moving higher for the foreseeable future. It is going to come. However, now is not the time, as you can see, during, of course, today's session, that you want to be aggressively attacking this market. I do not blame you whatsoever if you want to start accumulating positions around this area. That is a very intelligent decision in the world of markets and breaking down risk and reward. A very smart decision, but you must understand that it's going to, or at least you're going to have to sit through, of course, all of this yucky chop. So I wouldn't really encourage anyone to be placing extremely tight stops. If you do that, the probability of being stopped out of that bullish trade goes up exponentially. As long as we hold above support areas or support locations on the chart, once this all fizzles, ultimately, that's where, of course, the demand is going to flood the market, and we'll see the market move on up higher for a number of weeks, if not months, moving forward. You can see on the NASDAQ, again, an absolute bloodbath today. down 211 points, as I've already noted. This has got somewhat further to move. If you take into consideration, of course, where we were in February, at least where the February low was, this puts us actually below the rising 200 simple moving average. So you can see the 200 is coming in at 6,734. The low of this week is somewhat closer to 6,630. So you can at least expect another 200 points to the downside on the NASDAQ. And what I like about this in particular is that we have a very nicely defined bullish upward trend on the NASDAQ moving forward. So you can see that if I move back into the minor level, this is what this red sort of horizontal line on my screen is suggesting. That is, of course, that bullish upward trend that we have been in for a number of months. Okay, so pay attention to this if we do overshoot this green. A long story short, so to speak, is that we do have limited downside at this particular time, although, of course, the sentiment is exceptionally bearish. And again, when the majority find themselves in the bearish camp, so to speak, that's when you want to find yourself in the minority and thinking about the upcoming bounce, which is essentially going to come and flood into the market as well. So now's the time to not be going short, although it is overwhelmingly bearish. And we can agree that, of course, the momentum is still to the downside. It's more so to calculate, of course, your entry into the market long, but only when those signals show up. And that's only going to form with additional candlesticks, which equates to more daily sessions moving forward. So I hope you understand, I guess, the macro backdrop and also the blueprint of the market. A lot of people speaking about measured moves after these types of symmetrical triangles. Yes, I do understand that. However, you have to think about these rising 200 simple moving averages and look back into the past as to where markets have generally sold off into and where they have stabilized and ultimately reversed off from. And it generally is that rising 200 once you crack that rising 100 simple moving average. If we get on up back here and then we start to see reversals taking place, well, then we'll start talking about the change of the macro backdrop, and that comes into longer term trend reversals, okay, and potential market tops. But at the moment, we don't have enough evidence to really suggest that we are entering into that of a bear market. These things don't just happen falling off a cliff moving forward. They have to go through a certain sort of structural formation before they begin to break down. And of course, before they break down, they have to confirm the breakdown. And that is what is apparent right now, because this is going to form into that structural support area, which will eventually be broken if this market is to turn from this upper area once we get there. Okay, so this is all a process under construction. Don't be swept up in the emotion of it all. Don't be swept up in the 344 point net loss, or at least the 45 point net loss today on the S&P 500, and the same relatively speaking for the NASDAQ plus more 211 points. That's the wrong way to be looking at this market. Identify support, understand risk and reward, understand channels, understand areas, or at least the oscillators at least moving into oversold conditions and the natural, oscillation back up towards overbought. It's all a process, okay? And just keep the emotions or your emotions as far away from the market as you possibly can. Completely disconnect from your emotions when you look at the marketplace. It's really going to help you moving forward. Now, the one stock that I want to talk about above all else at the moment is Tesla. Tesla today got absolutely clobbered. I sort of have personally a love and hate relationship with Tesla. Tesla has been a fantastic stock over the past number of years. However, most recently during the months of January, February, and March, it has become a little bit chaotic. It has become a little bit disobedient, and because of that, it sort of pushed me off actually trading this stock. However, we have remained with this stock, or at least our perspective on this stock has been relatively bearish, and the reason for that is because of the multiple fractals of bearish divergence which has been forming on this chart, not to mention the consecutive number of retests of this support area and also the lower highs, relatively speaking, that have been forming. Today on Tesla, we saw a $25 loss. I mean, we didn't take a loss, first of all, but the actual stock price suffered that of a $25 drop. Now, we've been flirting with shorts for, again, a number of weeks, a number of months. The last short was over here at 331. We had to endure this little bounce to the upside. And then, of course, we have this dashed default area. Personally, I sat out of the short at 317. However, I have received a number of emails of people who've jumped in at 317, and I congratulate you for doing so. They hit their target today at 285. This was a trade that lasted about 7 sessions, And it has been an incredibly profitable trade. Today, again, just to recap, down $25. So it looks as though, above all else, the bottom has fallen out of Tesla. And this is just the beginning of a larger move. This is something that we've been recapping and speaking about for a number of months. This isn't something out of the blue. It's something that, that hasn't sort of shocked us. It's just taken a little bit longer than what we originally planned for. And for those of you who took the trade at 317, I just wanted to say congratulations. I personally didn't. And I'm sort of kicking myself at this particular point here on a Tuesday afternoon, because that would be looking incredibly healthy if you've got open derivative contracts on that, or even if you close them out at 285. My target on this is all the way down here at $262 per share. Also, to recap, gold and silver pulled back today. However, they established white candlesticks. So again, the actual close relative to the open of today's session was higher. So although the net loss was still down 79 cents compared to the close on Monday, this is still a relatively healthy candlestick. And it looks as though we're sort of just retesting this 127.50 pivot at the moment. So we are starting to see a little bit of gaps, or at least volatility, flow into gold and silver, and also commodities as a whole for the time being. However, silver is still largely stuck in beside this very short-term little range, so it's still range-bound. However, gold is looking as though it's on the precipice of breaking out. If I bring up this chart once again, and if I bring up that commodity channel index, you can see for yourself that we're flirting with that breakout pivot. That, of course, being the 100 signal line, but that is only going to coincide once we break about, or at least the confirmation is going to be achieved once we break above these two swing highs over here. So 129.68 is still the breakout trigger on gold if you're not in it. And that's going to take you all the way up to about $150 per share moving forward. So a lot of opportunity there on gold, and also silver if you wanted to place, say for instance, once gold breaks above 129.68 to actually open up SLV contracts. You can always do that as well, but the trigger should be at this particular point gold above 129.68 if you're not in it. However, there is still the possibility that this does come on back down, and that of course is only going to be a temporary sell-off. This is going to be ultimately X marks the spot on GLD if it chooses to do so. If it does, this is going to be the biggest blessing for those of you who are not in GLD, because once this happens, this is going to coincide with the US dollar staging a rally, which at this particular point seems to be breaking down. You can see Monday and Tuesday's candlestick. It looks as though we're breaking this short-term support area. But if we do see GLD pull on, or GLD pull on back down to that support area, that's going to coincide with the US dollar being bought a little bit, but ultimately moving back up to produce that next consecutive series of lower highs, which is going to work in conjunction with the oscillators moving back up into overbought, which is then going to roll over. And that's going to be the trade moving forward if we don't see gold simply break out from current levels. So the US dollar, again, a little bit sort of fragile at this particular time, but it isn't breaking down below the structural lows of January or either February as well. Now, again, just to recap a lot of these individual stocks, we have been expecting volatility coming from the broader market indices. Understand the process where we find ourselves. It's going to continue to remain rather volatile. But if there is opportunity to position yourself at relative support areas, it's always a good idea, or a potential trade opportunity moving forward. You just have to allow enough time with those option derivatives moving forward to allow for the ultimate base to be put in, and then the subsequent rally, which is going to push those markets on up to close those open windows. Apple today, or at least yesterday, we got stopped out at 170.54. That was about a 20-cent loss. It looks as though this is definitively going to move down to 162 and 155. That's okay. Once we get here, that will be the buy trigger moving forward to take us on all the way back up to 178. So, a little bit of volatility there. Amazon, again, floating with 1554. We had a pretty decent trade a number of weeks ago from the breakout up here. Again, if I bring up these rising exponential moving averages, it looks as though Amazon's going to definitively tag this 50. Okay, and at this 50, it is going to be, again, in this general support area of where I have my support, drawn on at this psychological round number, more or less where we closed at today, 1,500. All right, so allow Amazon additional time. I'm still liking that trade setup. Boeing Airlines was a profitable trade from for 2 weeks ago, pardon me. Again, we hit our target last week. We hit it again today. I think this is the third or fourth actual touch of this target at 322. It's still not ready yet. It has a little bit further to fall until we can trade that bounce, so allow it a little bit more wiggle room. Baidu today is pulling on down. It's very close to 227. Okay, still not ready to actually leg into new additional trades on this. Caterpillar is following that of the industrial average. You can see the reversal taking place on Caterpillar. This looks like that of a sort of descending triangle. However, it's still not tradable yet. So again, this is mimicking the larger process of the market. Now, COP's kicked the trend. It's still moving to the upside. You can see that we're still seeing some pretty healthy continuation to the upside as well. It looks as though we're actually going to hit our target up here at 60.26. Again, this is largely bucked the actual sentiment, or at least the momentum and the movement of the broader market indices. 55.26 was one entry, 56.89 was another. This is looking very, very nice, and I'm very happy about this. If you want, you can more or less move your stop up to the low of today's candlestick. This is what we call a doji little candlestick, or that of a high wave spinning top. So this trade has almost run its course. This is the first slowdown signal. So again, if you want to move up these stops, this is what I'm going to do more or less immediately right now. 58.65 is a really good stop on COP. Moving forward, we've got CVX, which is still moving sideways above 113.54, but below 116.15. It's doing relatively well considering the state of the broader market indices. Just hold on to that moving forward. GLD, this is what we have been waiting for. A long day Morobozu back into this green rectangular area of support. This is holding now at support, and we have also closed this window, or at least re-established this support area for the third touch at the moment. So look for Google to hold roughly $1,000 per share. This has been a stock that's it's been exceptionally hard for Google, so to speak, to overcome 1,000. And now, again, the really nice pivot, so to speak, of where we should see this base, okay, and then ultimately come on back up and close the window at 1,131, which may also align with that third, okay, consecutive lower high. All right, so you see the process underway, and something that I touched on when I spoke about the markets a little bit earlier. We've got Goldman Sachs coming down to 246. Although we didn't have a trade on this, it's something that we've avoided. The financials are being absolutely clobbered across the board. I would not be wanting to touch or go near any of those. We've got IBM trying to stage a bounce. It's holding its support. This is something you still have to hold on to moving forward. Netflix, again, is another stock that we spoke about, very similar to Amazon. Simply hold on to this. We've still got that rising support area at 280, that rising 50 exponential moving average. We are still in that of a correction, so if you pay attention to these oscillators, they haven't turned up yet, but these are mimicking that of a correction back into the 50. We do have an outside day candlestick, so we are still under a little bit of weakness for Netflix moving forward. And again, just to round out, Tesla today closing down $25 per share. So a relatively interesting day, full of volatility. If you have any questions whatsoever, email me. But please understand, at this particular time, what is most important is the larger picture. If you understand the larger picture, and if you can time the entry, or at least feel comfort in positioning yourself to make the advantage or take advantage of that major move to the upside, that's where the next trade is going to come from. It's not going to stem from what appears to be major losses in the market. If I show you the actual weekly chart, we're still positive. See, on the Dow, we're up 324 points. If I show you on the S&P 500, we're only marginally up 24 points, and the NASDAQ is a little bit different, only up 16 points. So you can still see sellers in control, but this picture is going to change, and don't think that it's not going to, because it will, and that's where the profit's going to be made on the swing trade back up. Okay, so on that note, everyone, enjoy your Tuesday evening. I'll be back with you again later in the week for another market update. I hope that settles any of the nerves that you might have. Again, by all means, email me, success@pivotpoint-trading.com. All the best. I'll see you next time. Goodbye.